Hey, Anthony, how are you?
How you doing?
Good, good. Let me just set up here for a second. So, Anthony is the director of communications at Royalty Exchange. Obviously, one of the big topics that we're going to talk about today, I'm sure it'll come up a lot. It's already come up a little bit, is around artists, writers, and their teams monetizing their catalogs. So, Anthony is going to talk about that. He has a lot of great data at hand from the work that they do at Royalty Exchange in this space. Anthony, I will let you introduce yourself a little bit. I think it always helps to hear it from you instead of me rattling off your LinkedIn, but love to hear about you, your background, what you guys are doing at Royalty Exchange, and basically turn it over to you and you can start your presentation.
Okay, so you want me to go ahead and get started now?
Sure.
Okay, I'm just gonna try this. I'm gonna share my screen here and make sure everything's working. Can we all see this?
Perfect.
Okay, great.
Looks good.
All right, excellent. Well, listen, first of all, Matt, thanks for having me and having us be part of this great event. I think it's very timely, so thank you. Yes, like Matt said, my name is Anthony Bruno. I am the Director of Communications for Royalty Exchange. Been in the music business for around 15 years in various roles. Mostly, some folks may remember I was a reporter at Billboard magazine. I covered the digital music space from around 2005 to around 2012. So something I've been involved with for a while. I did put together a deck to share some data and some information. It's really more of a conversation starter, right? This is not a seminar. I'm not going to drone on and on about Royalty Exchange, and this is not a sales pitch or anything like that. But I do want to explain a little bit about who we are, where we sit in the space, and share some of the things that we see in case it's helpful for anyone here who's curious about why people are suddenly investing hundreds of millions of dollars in music royalties. So with that, I'm just going to go ahead and get started. Please leave questions in the chat as we go along. I will address them kind of in real time. I don't want this to be like, okay, I'm going to go through 20 slides and I'm going to stop and ask a bunch of questions. We can do that, but please, I'll be monitoring the chat here, and I'll be answering questions as we go along if it's related to a certain slide and whatnot. Or if I skip to a slide, then you want to see more on the one that I just did, I can go back. Let's make it a virtual conversation and not just me. That's my goal. So with that, I'm going to go ahead and get started. Let me make sure that we're controlling things. So here we go. So the music royalty gold rush. You guys have seen the headlines, right? $150 million for 50% of Neil Young catalog, 400 million for Bob Dylan catalog, et cetera, et cetera. There's all kinds of things happening out there. It's happening every day. We just saw two deals just this week. I think we saw one with Red Hot Chili Peppers already just the day before yesterday. So clearly there's a gold rush. There's hundreds of million dollars coming into the space, okay? This is a slide I put together that kind of shows the landscape of what's been happening over the years. This chart here is actually from Forbes, which frankly I'm working on to update at some point and share soon. But this shows the cumulative amount of investment money that's gone into music royalties since 2010. It's a little bit wonky with some of how they sort of do the math and whatnot, but we were able to kind of figure out that basically just even in 2019, over $4 billion were spent on music catalog deals in that year alone. And looking like since 2010, according to this chart, close to 12 billion, already. You're seeing both public and private funds raising north of $4 billion collectively to acquire even more catalogs, and some of which have already started to be deployed. But what you're seeing for the most part in the press and the headlines and whatnot are these big funds writing big checks to big artists. It's sort of focused on that sort of 1% of the market, so to speak. I use that term roughly, but like it's the biggest deals that's generating most of the attention, and that's good. But it's the tip of a very much larger iceberg. All right. Real quick about who we are and why I'm even talking to you today. So we like to say that we use the power of markets to unlock the value of ideas. Basically, what we are is a marketplace that matches artists that have catalogs with investors who want to buy them. We don't buy or sell catalogs. We're not a broker. We are basically a platform that facilitates these sales back and forth. So we're very much a neutral party, and I don't really have anything to gain here by trying to increase what prices are or decrease what prices are. We're just the platform here. So we have a lot of data and a lot of insight that we can pass along. Real quick about what we've seen. We've seen around well over 1,000 transactions now taking place across our marketplace over the last 5 years. That's for a total of $92 million that's changed hands between investors and rights holders. We have I got here 27,000 investors registered on the platform. It's actually closer to 30,000 now. And like I mentioned before, with those larger deals that you see, the average deal on our platform is around $70,000. So you're seeing a greater volume of transactions in terms of rights holders and investors working together, but at lower levels than the big sexy headlines that you're seeing. Just to point out that there is a lot more activity happening there that individually won't get exactly a lot of attention. And the reason why is, here's some examples of what we've seen. You recognize a lot of the artists and a lot of the songs potentially in these auctions and other sales that we've had, but we're not working with, for instance, Miley Cyrus when there was royalties for Wrecking Ball made available. We're not working with, Jay-Z or Kanye West directly. We're working with one of their songwriters or potentially one of their producers. Those are names that aren't as well recognized, and they're selling a far lower percentage of what they have. So it's not as well, in any individual one deal isn't exactly all that notable. But the point is, there's a large number of people that earn royalties around music that can also participate in this gold rush that you just may not be aware of. So why are people buying this stuff? What's driving this demand? Why are investors coming to buy music royalties? What are they interested in? Are they just really huge music fans and want to spend $100,000 on it? Not really. What we're seeing basically is, in the investment community, and the founders of Royalty Exchange come from the investor community, they are looking for sources of what's called yield, right? They want to put a large amount of money into an asset that then generates income at a high percentage rate, preferably double digits. There are not very many opportunities to do that. Music royalties is one of the few. You could put a lot of money into a music catalog. That catalog will continue to generate income for you on a regular set basis, either monthly or quarterly or whatever it might be. And then that money can be used for other things. The funds do use it for one reason, but the people on our platform use it for others, and I'll get that in a second. Another reason that investors are interested in this is because of market volatility. Basically, music royalties is what's called an uncorrelated asset. If the stock market goes up or down, the royalty rate that you're owed for music remains the same. Right? It's not affected. The way that you earn more or less money from music royalties is based on the use of the music, and the use of that music is not necessarily correlated to whether the stock market is up or whether the stock market is down. The stock market can crash. People still listen to a bunch of music. Those royalties still continue to earn money in the same way. So it's a completely uncorrelated asset. And then finally, there is a lot more momentum in the music industry now by virtue of the growth of streaming. 3, 4, 5 years ago, when we first started this and we're trying to explain to investors why the music business might be worth investing in, that was a little bit of a harder argument to make. But I think over the years, we've seen proven out that the growth of streaming has definitely propelled this industry forward, and now you're investing in a tailwind. So those 3 reasons make music royalties very, very high in demand among investors. Who are they? Funds. You've seen the funds buying the big catalogs in the press, but there's also a lot of family offices, basically financial advisors for one rich family or one rich business, for instance. And you see a lot of individuals on our platform. It's mostly high net worth individuals. Think dentists in Ohio that want to add to their portfolio. These are also folks that are getting into the game. Again, what they're looking for are uncorrelated assets that generate yield and income, and they're looking for an alternative investment that's different from their other parts of their portfolio. Different types of risk, right? This might have a risk to it, but this risk is different than the risk that I have in my other assets, right? Now, why they come to us, they can still buy shares of Hypnosis or whatever in public areas, but they want to spend between $5,000 to $100 to $1 million on music royalties over our platform, and they want direct ownership. They want to be closest to the revenue stream. You buy a share at Hypnosis, which is fine to do, but you're basically getting the dividend based on what Hypnosis decides to pay their dividend at. You're last in line to receive a check. When you buy a royalty share, you are first in line, and they like that. And finally, they like the ability to choose which assets they acquire, and they like the ability to be able to sell it at any point if they want to as well. How do they value catalogs? How do they determine how much they're going to pay? Believe it or not, it's not just, hey, I recognize that artist, or hey, it's Bob Dylan, someone to pay a lot of money. There's more to it than that. First of all, it's age. Basically, we have a metric we call dollar age. It means it looks at the money that a catalog earned in the last year and try to see for how long has that royalty been earning, until that time. So if a catalog was just released last year and it earned $1,000 last year, that's not nearly as valuable as a catalog that earned $1,000 last year that's been earning for 10 years, right? So it's got a proven history of success. The Lindy Effect, as it's called, means the longer something is true, the longer something might continue to be true. So the longer there is of assets to examine, the more valuable it is for an investor. What we found is that catalogs that are 5 years or older sell for 20% higher than the median sale price on our marketplace. And when we looked at all of the catalogs that had sold for multiples of 10x or more, the average age was 13 years. So clearly the older catalogs are what's really driving invest. That's the primary thing that investors look for. Second thing they look for is what source are those royalties coming from? If it's streaming, then it's considered more valuable, right? That's the tailwind of the music business. That's the reoccurring revenue. That's weighted more heavily than, say, sync, believe it or not. A sync royalty is great, but it happened in the past. If I buy in it now, I need a sync royalty in the future to earn money, and I don't know that's going to happen. So I'm betting on streaming more than anything else. Again, streaming generates 60, for those catalogs that sell 10x or higher, streaming generates 62% of the earnings of those catalogs. Yes, familiarity. The investors will pay more for an artist that they've heard of before, for music that is by an artist that they've heard of before, but it's not necessarily always the case. We have plenty of investors that spend a lot of money on catalogs from music they've never even heard of, just based on the financials alone. And finally, they look at trend rates. They want to see whether the earnings are increasing or decreasing. More often than not, royalties do have a decay rate, but investors are going to examine the state of that decay rate. Is it decreasing at an increasing or decreasing rate, right? So anything around 5% decay rate a year, 5% or better, is in the range of what interests investors more than anything beyond that. So multiples, I added this at the last minute. We actually just did a study on this ourselves. So a lot of talk about multiples. Oh, catalogs these days are going for 15x, blah, blah. Maybe if you're looking at the headline generating ones for the Bob Dylans and the Neil Youngs and whatnot, but the fact of the matter is there is no standard going rate for music catalogs. There is no standard multiple that you could say, okay, I need to be getting this X multiple because that's what everyone else gets. It's really based on, again, the factors I mentioned before, the longevity of the catalog, the source of earnings, and the trend rate. This chart here shows a breakdown of catalogs we've grouped by age, okay? And I'll just point out the easiest one to see here, which is the yellow one. The yellow one are catalogs that are 7 years or older, okay? Generally, the multiples fall into around the 8 to 9x range for those catalogs, but they can be more. They can be up to 15x. They could be up to 20x, right? Why? Again, how old is the catalog? What is its source of earnings? What is its trend rate? So if you can examine those details about the catalog, then you can start to determine whether or not you can try to command an 18 or a 19 or a 20x for your sale, or if it's going to be closer to maybe a 10, 12, or even less of a multiple. Those are the factors that investors look for. All right, I'm going to quickly talk a little bit about why would you want to sell royalties in your catalog when you just are collecting revenue today. Generally, first of all, time value of money. We always say $1 today is more valuable than $1 tomorrow, right? You can put to use, if you're earning $10,000 a year, put that $100,000 to use today more effectively than you could just $10,000 that you get that year. Another point is the decay of royalties. Again, we say a 5% annual decline is considered about, when I say good here, I mean really it's about the worst you want to see it. But the point is, if you sell now, you're protecting yourself against potential further decay down the line. You hope that your royalties will remain constant over time, but they might fall. Taking some money off the table now protects you against that risk. And of course, there is a tax benefit to selling to a certain degree. When you earn money from your catalog, that's taxed as ordinary income. When you sell your catalog, generally, depending on how you sell it, you get capital gains. Capital gains are taxed at a lower rate. Here's something I wanted to share real quickly just to get to the decay rate for a minute. This shows how royalties earn by format over time based on catalogs that we've analyzed that have been submitted to our platform for sale. All right. And generally, what you're seeing is, first of all, these are all catalogs that were released within the 6-month period in Q1 2010. So that we just grouped all the ones that had that same age range and looked at how they earned over time. And as you'll see, the first 2 or 3 years on the left side of that chart was when they made most of their royalties. And most of those royalties came from the blue bar, which is radio. And then as the song aged, the royalties naturally fell. But as you see on the right side, it generally leveled off. Okay, and so that leveling off period might be a trickle for you if that's what you're earning or that's what your clients are earning. But for an investor, they see that as consistent and they love it. And what's really worth noting is the switch in format went from radio to primarily streaming, and to a certain extent TV and film for those that generated that income. So That's what you want to consider when you're looking at your catalog. This is the kind of normal trend rate you might see. So another reason why I sell 20-year wealth scenarios. We actually took this from the man who was on the prior panel, Daniel from AllianceBernstein. They put out a report, and we sort of just wanted to showcase what they came up with, were that there's different scenarios that you might want to sell your royalties. The scenario A is that if you had a catalog that was earning roughly a little over $500,000 a year, you could sell it for $8 million today, invest it in a typical 60-40 split, and after 20 years, you might be looking at around 15.4 million in return. Versus if you kept it, I'm sorry, that also includes the capital gains tax advantage, right? If you kept it and it just earned 560K a year even, right, and taxed as ordinary income, you're earning closer to 12 million. And then with the most likely scenario, which is a 2% decay rate over 20 years, which is actually very good. And again, taxed at ordinary income, you're looking at closer to 10 million. So there is some potential advantages for selling now and deploying that capital and investing that capital in other things that can be more advantageous than just hanging on to it. But there's also an element of diversification, right? A lot of people that we work with have a plan for why they're selling, and they want to diversify their revenue stream. They don't want to rely only on the music industry to fund 100% of their revenue. So they invest in other revenue streams. Some invest in real estate, business franchises. They invest in their own music to release new music. They buy stocks, etc. Some pay down debt, that kind of thing. But the point is, you're able to diversify your income streams and eliminate expenses if you are able to get a lump sum today to use. And finally, there is a bit of an alternative to advances. Now, typically, artists need money to make music. Right now, the way to get that money is to trade your rights to either a publisher or a label in return for a check. They give you other things, but that's basically the transaction. So you're giving away your rights for cash. You have to recoup that advance based on terms that are not exactly in your favor, and then you lose control over your copyright. If you sell your back catalog and use that money to fund any music that you create in the future, you get to retain those future copyrights. You don't have to pay anything back, which means there's a shared risk. Okay, if an investor pays you too much for your back catalog and doesn't make their money back, you don't owe them anything. That's much different than the label scenario. And then finally, with all of that, you get much more artistic control. So that's actually one reason why a lot of people come to us, is they need to fund their careers without going into debt and without giving up control. So I'm going to blaze through this last part really quickly. What are the secrets to getting the best deal? These are the things that we've seen guarantee success over time. One is to have a plan. Sure, if you just want to come in, sell off all your catalog, raise a bunch of money, and then just kick back, that might be your plan. But a lot of times the people that are working with us have a idea of what they want to use their money for. They're going to invest it or spend it on a very specific goal or a project. So having a plan is very, very important. And as business managers, this is kind of where you come in. Two is you be selective. You don't have catalog sales are not all or nothing deals, at least on a royalty exchange. You could sell part of your catalog, say 20% of your earnings, or you could sell 2 songs from your catalog, or you could sell only the royalties earned from public performance versus that you earn from publishing, like Mechanical and Sync and things like that. So you could choose which royalty streams you want to make available to investors, raise the money with that, and keep all the other royalty streams that you're earning separate. You could have a percentage, so you could say 25% of my public performance royalties of 25% of my catalog, right? You see how this kind of keeps going. And then finally, there is what we call a partial term. It's not necessarily a permanent life of rights sale. There are options to sell a catalog for, say, 10 years. After 10 years, the catalog comes back to you. The investor basically rented your catalog for a period of time, all of which are possibilities that you can use. Depending which one you use depends on what you want and what your goals are. Now, 3 is before you even start, you should know what you're worth. You could spend 20 grand on a large, catalog analysis and valuation, which for certain catalogs is certainly something that you should consider. But not everybody has that opportunity. Some people are selling catalogs for $20,000, and so they don't have the wherewithal to spend a lot of money on a larger, really in-depth catalog valuation. Ours is free. Basically, what we do is we're able to analyze your earnings, compare it against what sales on our platform has gone for related to similar types of catalogs as yours, and then we can provide you with sort of an analysis of what it might be worth. You can see your overall earnings. You can see your breakdown of earnings by format. this is what I've put here, but there's a lot of other stats that we can add, like regions where it's making its most royalty money and things like that. 4 is to create competition. Let's see how this works. I'm going to show you a time-lapse video of the last few minutes of an auction. This is working great. So we see it was at around 73 when it started. It's counting down, and you see the bids sort of just running in, right? And the price is going up, and the price is going up. And let's see here. I think it's going to stop at, when is it going to stop? 107. So just in the last, say, 5 minutes of the auction, it went from 73,000 to 107, over 107,000. And if you notice, I'll play it again. If you notice, the time on how many minutes of left kept increasing. It would go down to about 1, and then it would jump back up to 4. So what happens is we have a rule where any bid made in the last 5 minutes of an auction automatically resets the auction clock another 5 minutes. That way, all investors have the chance to bid more if they want to. There's no sniping, and that's good for the seller because it gets them the best price for their assets. But the point being is, with competition comes price discovery, and that's good for you. Oops. Let's try to stop that and move forward here. All right. Finally is own the process, right? A lot of times, if you're trying to sell a catalog, the people that are buying are the ones that are setting the process. They say, fill out this information. They say when they're going to get back to you. They offer you the first price. They're controlling that process. The best way to do a catalog deal is for you to control the process. You determine how much you're trying to raise. You find out on your own what you think, what the value is. You have some information to work with. You select the part of the catalog that you're willing to sell. You work with us to attract potential buyers. You define your terms, establish your deadlines, create the competition, and you dictate the terms in which they need to pay you for the catalog at the end of the day. You are in control, right? So if you want to have a successful catalog deal, own the process. And finally, work with experts, work with people who have sold catalogs and know what they're doing. That might be us, depending, because we've done over 1,000 catalog deals, but you might want to work with other people as well if you're going to work outside of our platform, which is fine. But the point is, work with someone that knows how to sell catalog to investors, who has done that before, who knows the people and who can create the competition for you. That's the one of the biggest things we could say. So, right, I'm going to blaze through these last parts real quick here. How does it work? Basically, you make the decisions, we do all the work. If you're working with Royalty Exchange, right? You determine what you're trying to raise, you decide how much or little of your catalog you want to offer, and you determine the length of the term of the deal. Those are all the decisions you have to make. We're the ones that are going to create your listing. We're going to put it on our marketplace. We're going to promote it to 30,000 investors. We'll manage all the bidding, all the offers, and we handle all the paperwork after the sale is done. There's different ways of doing it. You can do an auction, which is what I presented the time lapse before. It's basically a timed event. Bidders have to put in their bids during this 2 or 3 day period that the auction lasts for. Highest bidder wins, and the winner takes all. So it's a very focused, timed, urgent event for investors to make their offers if they want to participate. We recently added something that's called the direct listing on our exchange. If people would call Royalty Exchange the eBay for royalties on the auction side, the exchange is more like Craigslist. You can select the price, not a starting price and hope it goes up, but you say, I'm going to sell this part of my catalog for this much. I'm listing it. You can take a look at the earnings and you can make me an offer or buy it at what I've listed it at. It's up to you. And so that could be a little bit more of an indefinite time frame, right? But basically you get to control the process and you get to set the final price, whereas with the auctions, you don't. And finally, we've done a few things, very rarely what we call private syndicates. For much, much, much larger catalogs, $3.5 million or so catalogs, we were able to put it into what's called the private placement. Only accredited investors can participate in that. So we do have a subset of our membership that are, verified for that sort of thing. We do all the marketing to those investors. You set your price, we sell off shares of the catalog, and you then raise the money afterwards. So we've done it basically 3 times. Here's 2 examples. We did one with the co-publishing on Cage the Elephant. We did one for the manager's share of royalties for Dire Straits. They've all been very successful. So that's pretty much my spiel. I kind of went through it hopefully within time here. So
you're good.
This is supposed to end, but I wanted to open up a little time to answer any questions. And hopefully I didn't talk too fast because that is my Italian.
Yeah, a lot to digest. I know one question that'll probably come up is, are you willing to share this deck if we send it out
sure.
to the folks then? All right, so we'll figure that out.
I'll probably end up posting this on our blog, to be honest with you.
Okay.
With some more dialogue in it, and that'll have the in between the lines details as well. I can share that. That'll be easiest.
Perfect. I have a question from my side. So even as we were kind of researching and putting together this conference, obviously this has been such a huge topic over the last year. And I think, you know, a lot of the angles that you see in the articles is something like, you know, COVID has stopped touring. So all these folks are looking at how they can monetize in a different way, you know, generate some revenue for themselves. But it also seems like this is a much larger thing. Like it wasn't just COVID, you know, that was pushing this over the last year, that it seems like it was just part of a much larger thing, you know, the switch to streaming over the last 5 years. I guess, can you speak to that a little bit?
Yeah, so a common misconception is that people come to us to sell royalties out of some desperation or emergency need, and that's certainly, you know, sometimes the case, but more often than not, it's not. I mean, there are other ways. Like if someone's really desperate, there's other ways of raising money that might be a little faster, but frankly aren't as good deals, not nearly as beneficial to them. There's usually a plan. There's usually a much larger goal in mind here than just, oh, my touring's over, I need money. We have helped some people do that, but it's been a fraction of the overall business that we do. It's not that. It's really a financial decision based on a particular goal that they have, and a way of just kind of looking at their broader finances and their broader income and how they want to diversify that in different ways. That's really the primary driver. It's not so much the touring situation.
Sure.
But frankly, most of our people that work with us are songwriters, so they're not going on tour anyway. Gotcha.
What about, you know, in terms of these teams, I'm thinking of the business managers and their clients as they're, say, evaluating something like this. You know, you mentioned they can sell certain songs, they can sell a percentage, they can, you know, receive the rights back in 10 years. How, you know, do you have pointers or resources? Like, how can they go about evaluating, you know, what to do, how to start to structure it?
Sure. Yeah, we can work very closely. I mean, we could be as hands-on or as hands-off as you require. So once we understand what your goals are and what, you know, like I said, if you have a number that you're trying to raise in mind, once we do the analysis, we could say, okay, if you really only want to raise X amount of, you know, of dollars, based on your earnings history and which songs are the ones that are doing most of the earnings and things like that, we could say you could either only sell these, you know, group of songs to get to where you need to go, or you could, you know, if you don't want to, if it's too complicated in terms of the paperwork and whatnot, you could sell the whole catalog, but only this percentage, because this is where it'll likely go. And here's the price that you can set it at that we are fairly confident that investors will respond to. All right. So we can provide all of that feedback based on what we see buyers on our platform, how they behave, right? And you'll have the benefit of having all that data as you make your decisions, okay? But at the end of the day, it's still your decision, right? You can still, we're not going to tell you what you need to list it at. But if you have a price that's like there's some people that are like, I want to list it for 40X, I'm like, or something, I'm like, seriously, and we might be like, it's not going to work, and it's going to be kind of a waste of time. So we'll be very, very clear and upfront and honest with you about that as well.
Sure. What about, say, you know, for any of these folks, for the advisors or say the songwriter, you know, the artist themselves, from their end, just in preparing for a sale, in terms of just due diligence, what they need to prep from their side, make sure that they have, do you guys have a checklist or just certain things?
Yeah, so we
guide them through that.
I wouldn't, you use the word due diligence, so I'll use that, but that's kind of a weighted term like in legal space and whatnot. But, you know, we are going to ask you for the elements that we require. Generally, it's going to be statements that are in readable form. We're going to check with the distributor of whatever royalty stream that we're working with to ensure that there's a clear path to ownership and there's no encumbrances like liens or anything like that against it. We do want to make sure that the distributor is one that will have the capacity to be able to divert payments to a new owner. We administer that for the buyers, but we're going to do the work on the back end to make sure all of that is clear. So I guess in terms of preparation, it's just really knowing, you know, do you have any advances that need to be paid off that can be like if you have an advance that's higher, that where you owe more than what the sale can probably generate, then we won't be able to work. We won't be able to help you, basically, because it's not gonna do any good. You're still gonna owe money, and then the investor's who bought it's not gonna receive any revenue because it's still being, you know, garnished, so to speak, by whoever you owe the royalties to. So you got to have any of your advances sort of lined up. You got to, you know, have your tax situation lined up. It's not a lot of work to do. This is stuff that you should already have done. And if you're coming to us and we find holes, so to speak, in that, then that's something you're gonna have to address, but you're gonna have to address that whether you're working with us or not, right? So we can maybe help you identify some of those areas if that's the case.
Awesome. Cool. Yeah. And if anyone has any questions, just drop them into the chat. But I was going to ask also, do you have any like teaser of upcoming tools that you guys are releasing, or, you know, even just kind of things into the future that you're looking forward to, changes in the industry?
Sure. So I guess everyone asked, you know, what are we doing with NFTs and crypto? So, you know, we are looking at NFTs. You know, NFTs are collectibles for the most part, not necessarily a reoccurring revenue source, but they could be. And so we're examining how that might, how an NFT as a format might work from an investor standpoint. We're not looking at like going fully crypto or anything like that, but it is an area that we're you know, watching. It just needs to be far more widespread. But a newest thing that we did add that I can talk a little bit more about is a new investing format that's more of like a direct, more of a traditional advance, in the sense that if you're an artist and you want to sell a portion of your royalties, but you don't want to like sell them, what you do is you could say, okay, I'm looking for an advance of X amount, and I'm willing to pay back as much as Y. Okay, we'll put that on our platform, so it's a fixed investment for the investor. The investor says, okay, I'm going to buy this, and I'm going to collect royalties until I collect this amount of money that's already been set by the seller. And once I collect that, the royalties go back to the owner. Okay, so it's a fixed return investment, and that's a newer thing. And what that does is that's basically better for younger catalogs that don't have that proven earnings history, where you can get an advance and the investor knows exactly how much that they're going to collect, and so they're willing to pay more for that than they would if they were to say buy it even for just 10 years, because it's far riskier than and you as a seller will collect far less. So it's a new option for sellers who just want to have a shorter term 2-3 year type deal that's just based on a fixed return, but it's also competitive with the investors bidding on how much they'll pay to get that return. So those are probably the two newest things.
Awesome. Well, that was a lot to digest, but like super informative. So I will talk and figure out if we can send this out. For sure, we'll send out the recording of this so people can watch it, or right, you know, send us that blog then, and we can also post that.
Sure.
Thank you very much for taking the time today, putting this together, sharing all of the insight that you guys are gaining. You're really kind of at the crux of obviously an industry that's exploding.
Sure.
And there's your email.
There's my contact information. If you want to hit me up with anything, I'll be more than happy to help in any way I can. Thanks very much for having me again. It's a great event.
Awesome. Thank you, Anthony. Have a great one.
Okay, you too. Bye.
See ya. So we are going to take a short little 15 minute break. We'll be back at 1:55 Eastern, or what is that, 10:55 Pacific. So we'll take the stage down here. You can just stay on this tab. When we come back, we're going to do an hour-long panel with 3 top-notch business managers. So we'll kind of dive more into the details of what they've been doing, what their clients are doing. And then another really interesting presentation after that around lending against catalogs. So we'll be back. Feel free to use the networking function, which is the people tab on the left. And yeah, we'll be back in about 14 minutes or so. All right. Thanks, everyone.